What's up, startup founders? I'm Sam Wong with Fundable Startups, and we just released a new training class on startup due diligence, best practices, and tools. This class is vital to companies that want to raise investor funds because 80% of startups fail due diligence. When this happens, your fundraising gets delayed by 3 months or more. Our class covers what to do, the best practices, and how to do it, the toolkit. This video is a replay of a webinar where we announced the training course and provided a quick class summary. You'll want to pay close attention to the middle of the webinar where we talk through several color by numbers tools in the toolkit, including a diligence tracker that helps founders and investors run and finish the diligence process, a cap table spreadsheet that helps everyone visualize dilution and risk, a financial model, and several other fill-in-the-blanks tools that will save you 40 to 50 hours and thousands of dollars in legal fees. More importantly, these tools can be the difference between raising startup funds or continuing to get rejected. As an investor with Band of Angels, the oldest angel group in the US, I designed and built the tools to help me decide whether investing in a startup makes sense. So, founders who deploy these tools will have a clear advantage in the fundraising process. Let's get started. Thanks everybody for joining us. Good morning, good afternoon, good evening, no matter where you're coming from. We're grateful that you've given us your time. My name's Sam Wong, and we are going to do a session. This is a brand new topic for us. The topic is startup due diligence, best practices, and toolkit. So in terms of background, I've been in the startup community for a number of years after I left management consulting, did 5 startups. I was a VP of the first 2 startups, which unfortunately both shut down, VP of engineering of both. And then thankfully, startups number 3, 4, and 5 all got acquired. As a CTO, CEO, and a VP once again for startup number 5. And then also had advised 2 other companies that were also acquired. So the interesting thing is that people do focus a lot on raising funds, of course, in the startup space, but startup number 1 raised the most funds of all of these companies, and it still shut down. Startup number 2 had the best tech, absolutely the best tech of any of the startups, and they also shut down. So it's not just about money, it's not just about building a great product. It certainly helps, of course, to be able to have those things, but to me, it's really about execution, which is what led me to write a book on startup success. The book is 21 Secrets of Successful Startups, and we focus exclusively on startup execution, financing topics, people topics, as well as life and wellness types of topics in the hectic community of the startup space. I have done a lot of speaking engagements, spoken at TechCrunch Disrupt a couple of times, spoke at the Lean Startup Conference, have a lot of partners. I volunteer and also serve as a advisor for a number of Bay Area accelerators. I'm also an active member with Band of Angels, and since joining Band of Angels, I've been doing probably 2 to 3 diligence sessions, it seems, on the investor side per month. Okay, and that's really what led me to putting together a class. So this course or this webinar here is really a summary or a snippet, not a summary, a snippet of our new startup due diligence class. It's best practices and tools. And we built this class because proper diligence is kind of like doing a military inspection. There are going to be some investors and companies that will do light diligence when you're trying to fundraise, but then there are going to be others that will do more heavy diligence, and you need to be ready for both scenarios. The sad reality is somewhere between 75 to 80% of companies fail diligence, and when you fail diligence, that results in deal delays, deal distress, and maybe even deals dying, okay? So we're going to try to help you with some of that. The full course on my website, fundablestartups.com, covers these topics. In this session here, we're just going to focus on a portion of section 3 and go through a little bit of the toolkit as well. Okay, so we don't have time to go through all of the content. It's taken me about 300 man hours to put this course together so far, because a lot of those hours were spent putting together the tools in the toolkit. Okay. So there are two triggers for investor due diligence, and that's, excuse me, for due diligence. One is investor fundraising, which is probably 98% of the time that diligence is done, it's for fundraising. But there is also another trigger, which is mergers and acquisitions. Okay. Um, and as you saw in the previous slide, been through M&A diligence 7 times, six consummated deals, and one that fell through. Investor fundraising, dozens. Okay, done it. The diligence, been doing the diligence from both the investor side as well as the founder side. So a lot of the fractional roles I take, probably almost half of the work that I do for a lot of startups, especially as they're helping them fundraise, is helping them to get through diligence. Okay. So with so much pain and effort going through diligence, that's what transpired in me kind of creating this toolkit, which is going to be summarized here in this session. Okay. So again, reminder, feel free to pop in questions in the chat window. So what it comes down to is, okay, why is this hard? Well, number one is that there's lots of people talking about diligence, and most of them provide a checklist, which is helpful in many ways, so that you can at least familiarize yourself with what might be asked when you get real interest from an investor, what that investor might ask for you to show them about your company. So, I've gone through and downloaded about a dozen different checklists from a lot of different companies, including Y Combinator, Band of Angels. We have our own checklist, Sandhill Angels, and a number of other prominent startup facilitators or investors, if you will. I've tried to distill them into a unified view of the checklist. And you may say, well, why would you do that? What's wrong with the existing checklist? Well, the reality is that the existing checklists focus primarily on function and not on usability and organization. Okay. And what that focus on function, a rigid focus on function, is that it falls short because, I found this picture of this guy who put a folding chair inside it looks like a truck. Yes, that's functional as chairs go, but it's not really that usable for a car. Okay. What you really need is something that's both functional and usable. So let's look at the due diligence request list in general. Okay. So due diligence is when a third party conducts an inspection of your company to assess the risk. And I have here a sample due diligence checklist from Vincent Louis, formerly of Rhapsody Ventures. There's 202 items on the checklist spread across 41 different categories. And most people, when they think about putting together a diligence list, whether it's this long or whether it's a much shorter list, they think functionally, like I want to see, this type of contract over here. I want to see, customer detail over there. I want to see company formation stuff. And what it starts looking like is when you organize it like that, it's a functional organization, but it really doesn't apply. It has no correlation to the real world, okay? Because it doesn't matter that you put all the pistons of the engine in a row here, and you put all the gaskets over there, and you put all the nuts and bolts in this sort order, okay? Because that's not how it's used, all right? So the challenge after going through dozens of diligence cycles is that you need to make diligence intuitive and easy to navigate. From the founder side, the question you ask is where do you put the documents? From the investor sides, where do you find documents and how do you use the relevant documentation? Because I have seen many situations where I'm given a data room as an investor, I'm given a data room, and because I didn't put together the structure of the data room, they put documents all over the place, and where I think that document should be, it's not there, it's someplace else. Now, certainly you can do some searches, of course, but it's just a lot more complicated to be able to figure this out. And when you're an investor doing diligence 2 to 3 times or more a month, and every data room structure is different, it's just a pain in the backside. Okay. So what I proposed in putting together our diligence framework is to organize the documentation by role and by usage. So conceptually, on the founder side, who creates the documents and who compiles these documents? And then on the investor side, who is the party that reviews the document? We want to organize the diligence into usable categories. And I think just a month ago or so, I came across a startup that gave a diligence data room that I think had 27 different folders in it, top level folders. And I looked at it like, I can't find what I'm looking for. And if they didn't do the file names carefully, then doing a file name search does not easily lead me to the document I'm trying to find. And it's that little friction that just gets very aggravating because there's a lot of things that I want to be able to inspect. So what I proposed is to organize the diligence into categories based on how it's used. First is fundraising. These are all the documents related to the pitch that you're delivering, as well as the deal you're trying to close from a fundraising perspective. Those documents are typically organized by the CEO. Okay. Then you have financial documents. And by financial, these are all documents where numbers take center stage. Okay. Anything except for what I mean by is non-technical business numbers. If you're doing some type of data science type stuff and there's numbers that help you build your product, that doesn't come in here because this is non-technical business numbers. And this would be typically content and documentation that is compiled by your CFO or the person who's your fractional financial lead. Then probably the biggest category as time goes on is going to be the legal documents. This is where if any document were a signature, a government filing, or in general, risk is the key factor. So this would be everything from your job offer letters, which should be signed, to your stock grants, to your government filings, like when your company was formed, contracts, of course, that you signed with customers, partners, or whatever. And this is typically done by your head of legal. It can be an outside law firm, or maybe your head of operations, somebody who is responsible for making sure that all these legal documents are well organized and tidy. Okay. Then there's another section full of technical content. This is geeky, nerdy content. And this is going to be your typically your CTO, your chief scientist. If you're a drug development company and you have this interesting molecule that you're trying to commercialize, trying to bring to market, then all the science stuff behind that molecule, all the academic research or whatever would go in here. If you're doing something where you're building an app or a website where the technology behind the app is key, you might have stuff like open source library usage would come into this technical section. Okay. And then there's another section, commercial diligence content, and that's about running the core business, and that's where the operations person or individual line VPs would sort the content. Okay, so there's a question in the chat about, well, where do patents go? Very good question. Anyone want to take a guess? Okay, I'd love to be able to get everybody's feedback. Just drop it in the chat. Where do you think amongst these five columns, where do you think patents would go? Okay. I'm glad that we're getting a lot of responses here. It looks like probably 80% would go under legal. Okay. And that's where I actually organize it in my content, because what most founders or investors, excuse me, what most investors care about is the fact that the patent, at what stage is the patent in? Okay, so putting the patent filing and the details into the legal folder is where it's most commonly found, and it's typically where third-party diligence lists would put the patent info. Now, if you have claims or individual items that support the patent, but isn't actually part of the final filing, then you could put that into technical if it's asked for. However, most diligence lists don't usually get into that. They just want to know the status of the patent. So that's why most people put it into the legal section, as most people in the chat window here had indicated. So your guess was correct, and that's where we would put the legal. And that's an example of, is this intuitive where the average person, without doing a lot of research, if this is how the average person would answer, then we want this to be intuitive so it's easy to find once you dig into the legal directory. Then instead of 27 different folders to be able to search through, you just have a smaller set to comb through. Okay. All right. So let's continue here. All right. So we're jumping through different portions of the course just for the sake of time, but I wanted to be able to cover diligence. Typically, that's covered in a small fundraise. So the larger amount that you raise, the more diligence content the investor will ask for. Okay. So, because the vast majority of fundraisers are small, okay, volume wise, we are focusing initially on diligence for small raises. By small, I mean less than $500,000. Okay. Once you get into the $1 million fundraise, typically the diligence list gets a lot longer and it gets a lot more time consuming to actually have to fulfill. But if you build this correctly, when you set up your diligence infrastructure for a small fundraise, a $100,000 fundraise or whatever, and you maintain it, then you can use the same diligence infrastructure on the larger fundraise just with additional categories and content. Okay. And our current version of the course is focused on the small fundraise. We will release a subsequent phase of the course, which will expand the diligence framework for the $1 million fundraise. Okay. For the million, 5 million, 10 million, those types of fundraises. Okay. So we've got those five categories. Let's look at the actual documents that I'm recommending that you prepare for based on all of the dozen or so diligence checklists which I reviewed and compiled and basically distilled. Okay. So in the fundraising, the docs related to the pitch and the deal. You have your latest pitch deck. I recommend you having a one-page executive summary. A number of investors like having that. That one-page executive summary is probably the most common document that the investors at the Band of Angels will review. Okay. So it's a key document. Uh, Oftentimes, many investor checklists will ask for a list of other interested investors so that they can potentially coordinate some of the logistics of the fundraise. A key element is going to be your funding journey, the past fundraise, the present, and the future. And the goal of this is putting it together in a way that allows you to be able to see the growth. And I'll give you an example of that later in this webinar. Okay. Then there, if you happen to be far enough along where you've already set up your investment agreement, maybe it's a safe or a convertible note. If you have that set up, then you probably want to put the investment agreement here. I put it here and not in legal because at this point it is an unsigned, unnegotiated document. Okay, because it's part of the fundraise and it's not signed yet. I put the contract template here. Okay, then we also have exit analysis. This is something that the Band of Angel asks for and something that I ask for regularly when I'm looking at investment opportunities. Is I want to be able to see comparables of past exits, either acquisitions or even an IPO. Okay. And when I see those, there's a certain amount of information that I want to be able to capture that I'd like the founder to be able to provide so I can quickly assess the potential upside if there is an exit. Okay. So financial. There's another question here before I get into what are the key sections that the executive summary that business angels like to see that you suggest? So, I actually, if you look at the toolkit, the Band of Angels has, I think, one of the best one-page executive summary. Okay. There's another executive summary from Syracuse University, which is okay, but I tend to prefer the band because I think the band's format is much more complete. It's so dense that the average founder probably takes a full day to fill it out because most founders have the information, but condensing it and making it fit on one page, that's the hard part. Okay. But if you go to that effort, not only does it benefit you and the investor, it helps you distill your messaging. So there's an indirect benefit to you as a founder. Okay. So there's a question. Can you provide a link? Yeah, I will do so when I have a moment. Okay. And it's also included with our toolkit, but it is something that the band distributes. I may actually create our own version, but right now I just point people to the version that the Band of Angels uses. Okay. So, financial content. What does the typical investor look for a small size fundraise? Well, of course, the cap table. This is probably one of the most commonly asked for, requested pieces of financial information. And one of the most important things is to make it usable. And I'm going to get into that in a little bit. Okay. Let's see, financial statements. This is a big deal. This should include financial disclosures and your infrastructure details per AICPA, American Institute of Certified Public Accountants, and generally accepted accounting principles. Okay, you'd be surprised at how often I look at financial statements and say, this is inadequate. I cannot rely on these statements and these financial statements because it doesn't look correct. There is no documentation about an unusual six-figure transaction, and I've kicked back the diligence, and we have stopped diligence because the financial statements were pretty shoddy. Okay, so oftentimes your investor also asks for a 3-year financial model. This is super difficult because everybody does a model a different way. And when I receive the model, it's usually unreadable. And it takes a good amount of time for me to sit with the founder to say, help me understand your logic here. And we'll talk about how we address that with our toolkit. One of the most common things nowadays is a QSBS attestation. Any tax savvy modern investor should understand that QSBS, qualified small business stock treatment, is absolutely key. We'll get into that as later. Okay. Also, 409A valuations, if you have them. Okay. And on the legal side, for a small fundraise, I see is one of the most important things to do is schedule a meeting with your head of legal. And in that meeting, it will probably be a verbal, just a verbal only conversation to talk about processes, procedures, and typical standard forms, etc. A lot of angel investors will ask for a boatload of contracts here and then never look at them. Okay. It's fine to ask because it's reasonable and fair, but what I'm trying to do is find the right balance between being onerous and asking for too much information versus asking for too little information and then being exposed to an unidentified risk. Okay. So, of course, charter and bylaws, this is to make sure that your company is in good standing and real. If an investor is going to wire transfer money to a bank account, I want to know that the owner of that bank account is a true corporation, not my cousin Vinny, who's just going to go live large once the wire transfer hits. Okay. So, org chart, just to be able to understand visually who's who in the zoo amongst the key players, and then a listing of the key members, including references for founders. The band and many other investors do reference checks on founders and do make phone calls to and schedule conversations with other members of the core team. Okay. On the technical side, oftentimes the diligence checklist for a small fundraise is just a meeting with the head of technology, and you'll cover certain things like the technical team, maybe processes, any technical debt that exists with the platform as built, your budgets for moving forward. If this is a hard tech environment, maybe the science behind your hard tech, help understand how AI is used, the architecture of the product, IP in terms of this is the technical side of the patent question that came earlier, and then details like adoption and risk management. The adoption oftentimes results is a requirement of the technical skill and playbook of the company, and adoption is key for any company that does recurring revenue billing. If the product is not adopted, then the churn is likely to be higher. So that would be covered in a lot of the technical. Then on the commercial side, this is documents about running the core business. Well, investors typically look for sales pipeline and metrics, list of top customers, metrics, and references. We do contact and call customers as well to be able to get their perspective, and then potentially validation metrics. And if you happen to sell through a channel, maybe partner pipeline and pipeline metrics as well. Top list of top partners. The exact content will sometimes vary based on the type of startup that you are. Okay. But those five major categories map to a data room, basically a directory structure. The top five results in five top level directories. There's a number of subdirectories underneath with a file organization structure that I propose as part of the toolkit. Okay. And what I'm really trying to do with this here is understand and optimize the diligence process. So now we've just talked about lists and things like that. It's like, okay, fine, whatever, great. How does this actually work? Well, I'm going to show you. Okay. So you have a founder and an investor. The founder pitches the investor, and the investor says, that sounds interesting. Okay, fine. I would be interested in moving this forward. And they're going to ask for a diligence checklist. Okay. Any substantive investment, like if it's a $10,000 angel check, maybe the diligence checklist is very, very small. Okay. Or it's just the stuff in the pitch deck. But if it's, six figures and above, oftentimes the diligence checklist will be 30, 50, as many as 70 items on the checklist. Okay. And then it's the job of the founder to compile the content. It's a process where, I've done this on the founder side multiple times where we do daily phone calls with my internal team and, my client's internal team to say, where is everything? Who is working on a specific line item response? What line items are stalled? What exactly does the investor want? Because sometimes it's not clear. Okay. So you might ask a question back to the investor to say, what exactly are you looking for here? And help me understand so I give you the right thing. The investor responds with an answer. And then there's usually a lot more than just one question. You're going to do a number of back and forth cycles with the investor to make sure that you're compiling what they're looking for. Then you are managing this just like a project. What's the status? Is something stalled? Okay. How close are you from getting the entire checklist done? And if there's a certain line item that is blank, what does that mean? Is it because work is started or is it not applicable? Or, what does that exactly mean? Bottom line is that this is a lot of work. Eventually, you compile the content and you provide the data room as requested to the investor. Great. What does the investor do with that? Now they're going to review the content, and the same, similar to the compile content side on the review content, the investor will usually, especially if it's a team, they will divvy out the responsibility of, okay, you do this, etc. And we have to manage who is owning the review of a certain area of the response, which reviews are stalled. Is there some missing info? Okay, and this happens a lot. A lot of the information coming from the founder is incomplete or unclear. So you'll ask the founder for, give me more detail here. You didn't answer the question correctly, or you didn't provide exactly what I was looking for. And then a response comes back. And unfortunately, what happens is that this cycle of asking for more detail, a clarifying question, and then more data comes back, you do this iteration over and over and over again, which is why some of these diligence cycles, especially for a price round, can take 4 to 8 weeks. The last price round that I helped a founder close took 8 weeks to close, mostly because of all this diligence back and forth. Okay. And when you do the back and forth, especially when your attorney is involved and they're helping you with this stuff, guess what? They're on the clock and your legal bill just goes through the roof. Okay. 20,000, 30,000, $40,000 extra just to do this diligence stuff. So if you're closing a price round, you should probably expect about $100,000 in legal fees. All right. That's roughly about half for your investors' legal fees and your own. It could be as low as 80, but somewhere in the 80 to 100,000 range The last round that we closed was $168,000 in legal fees to close a round just under 5 million. Okay. And it was that high. It was much higher because of all the back and forth. And seeing all that back and forth is again why I put together a lot of this toolkit here. Okay. Um, Once you have all of the requested data items or diligence items clear, now the investor has to ask, what is the impact of a risk? You're basically identifying risks, okay? What is the probability of that risk? And then after you've looked at all of this, which are the top risk factors and how does that affect my decision to either invest or not invest? Okay. Bottom line is that all this is a lot of work. And guess what? It's manual. There are no tools really. Okay. So this is a challenge because without the tools, it's super inefficient. I don't know if anybody here is a homeowner, but when I first became a homeowner many years ago, I realized how many tools I needed, and it really helps a lot. Just you need a hammer drill, to drill through masonry, or you need a a handheld a baby jackhammer to take tile off the wall or something like that. Having the right tools can make your life a lot easier. Okay. And that's what we're trying to do as part of this diligence process. Okay. Okay. Is we're trying to give you some tools. Okay, so Brian brought up a very good point about counseling clients to include a README first document beginning of each category folder. I would take that even further. It's not even at the category folder, it's at the line item request level, and we have that covered in our toolkit. Okay, so I completely agree with Brian. You need to provide background and context and color to help people reduce the number of cycles. So there's another question. Can you find a large legal firm that will help you through the due diligence process for nothing, expects to become your law firm once money is raised? The answer is no. Any large legal firm, an AmLaw 100 or above, to do the diligence for zero, it's going to take them probably 100, 200 hours and stuff. They're not giving that away. An AmLaw 100 legal firm, the associate level is going to bill at $600 an hour, maybe. Okay, the partner will bill at 900 to 1200 an hour. All right. If it's 100 hours, then there's not likely that 100 times 600, that's $60,000. So Rick mentioned you've done it twice. Congratulations. I've never seen it done for a small firm. Maybe if you're a largest firm and the um, the firm really wants your business, okay, maybe if they know your run rate is going to be $1 million a year, sure, they'll give away $50,000 in legal fees. But most startups don't pay $1 million a year in legal fees. Okay. All right. Yeah, I congratulations, Rick, on the fact that you were able to get that done. I remember I talked to the same law firm, DLA Piper, on a M&A deal that I did, and they wanted $150,000 out the door for a seven-figure acquisition. Okay, that was before we even got started. So congratulations if you can get it. I just don't see it happening very often. Okay. All right, so let me continue go forward with this. Um, so the tools in our diligence toolkit. All right. Number one is the diligence response list, which helps you manage and track. Okay, this is the anchor tool for our toolkit here. All right, and we'll show you how that all works. Second tool, a pitch deck template. Probably don't need that because you have a lot of stuff, but for me, it helps because I like seeing pitches done a certain way. Okay. A one-page executive summary, which I already mentioned, the Band of Angels. The interested investors. All right. There's another toolkit to be able to summarize that because it's not just a list of names. There's other things that we probably, as a peer investor, would want to see. The funding, the past, present, and future. I'll demonstrate. I'll show you some snippets of some of that in our tools, as well as the. I don't think I've have time to cover the exit analysis, but we have a financial spreadsheet that helps compile that so that an investor can be able to see how that all works. Financial cap table tool. Okay, and you may say, well, there's Carta. Okay, well, we'll get into that. Future option grants so that we can understand as an investor whether you have the staff and whether the option pool is properly sized for the people that you want to be able to hire. Then existing investors, okay, the toolkit includes a 5-year financial model, and then a QSBS self-attestation, notes on financial statements, financial infrastructure details, legal infrastructure details, a legal review outline, team org charts included in the tools kit, as well as a tracking tool to record the core team members, not just founders, but executives, advisory board members, and board members themselves. Okay. So on the technical side, an outline for technical review, commercial, sales pipeline, top customers, partner pipeline, and top partners. Okay. So these are the tools that are currently included with the toolkit. There's a question that comes, please help me understand because something does not make sense. If I raise 300,000 and 100K to goes illegal, maybe I wasn't clear. 100,000 legal fees is not common for a 300K fundraise. The 100,000 legal fees is for a priced round, which is typically 2 million and above. Okay. So if you're doing a 300K fundraise, you'll probably not incur more than what the purpose of stuff like a safe template is to avoid engaging an attorney altogether. Okay. So most of the 25 and $50,000 safes and convertible notes that are signed are done with very little legal review. Okay. But there is still a lot of work done by the founder and the investor on this diligence effort. They may not involve paying an attorney for a 300K fundraise, okay? But the work still has to be done, and it's going to be done, of course, by the founding team to put the content together, and somebody on the investor team has to sort through it. On an angel group, it's oftentimes the angels themselves as they go through the low-level detail. Okay. Yeah. Scott's comment. Yeah, find a good lawyer, 500 bucks an hour, and pay 5 to 10K on a smaller fundraise. Of course, I'm not saying 100K is the typical legal fee for a 300K fundraise. It's not. Okay. You can get away on a 300K fundraise with paying close to zero. Okay, depending on how clean your company is. But I do agree it should be much, much lower. No one's suggesting that you pay 100,000 for a 300,000 fundraise. That's not reasonable. Okay. All right. So, let's talk about some of these tools. Let me give you an overview, okay? This is the Diligence Response Manager. Consider it the diligence checklist. So, the investor puts together in the tool a list of the requested line items as organized by those 5 groupings, the fundraise, the financial, legal, technical, and commercial. So it's organized by those 5 categories. And then there's additional context on each diligence item. Notice that the context is much larger than the request, in line with, I think, Brian's comment about providing background and context, or a README. This is the content for the README, if you will. And notice it's on a per line item level, not on a per group level. Then you have the status of the response because the founder and the founding team is going to start working on it. It's in progress, stalled, or done, or whatever else. And then all those stats are summarized so that the management team can say, "Oh, I'm 50% done. I'm 70% done responding to this diligence request list." The owner of the response, as well as clarifying notes that you might want to just give to the investor. So it reduces the amount of back and forth. If there is something you need to say very briefly, you can put it right here, right next to the response. Then once the investor gets it, they have the review status. They also have the statistics similarly that, hey, we are 30% done with the review, 70% done, whatever the process is. You have the owner on the review team. Maybe it's your first year MBA. That's the finance, the numbers guy. He's going through all the spreadsheets right now. And that owner would put any notes about what they found. I like this about the spreadsheet, but I have some concern about this, this, and this. That results in risk impact, probability, and priority. Okay. So the person who's doing the review would assess the risk impact. If I get hit by a meteor, the impact is I will probably die. Okay. But the probability of me being hit by a meteor is extremely low. So the overall risk is not that bad. Okay. So the combination of impact and probability is how you want to mitigate those risks. Okay. So that's the cap table. Excuse me. That's the diligence response tool. Now we're going to talk about our cap table tool. And you may ask, why do we have a cap table tool? Carta is free for, if you haven't exceeded their thresholds, you can get Carta and many other cap table tools for free. Well, Carta is probably the most popular cap table tool out there, but their reports are very, very hard to digest. This is a screenshot of their convertibles ledger. Notice that it's very wide, so you do a lot of horizontal scrolling. It doesn't tell you whether the safe that's signed is a pre-money or a post-money variant. It hides the valuation cap, kind of buries it in the middle of the report instead of to the left, where all the important stuff is to the left. It's there, but you kind of have to scroll. The screen's so wide, you got to scroll left and right to be able to find it, which is kind of painful if you have 20, 30 convertibles. You gotta somehow do a split screen thing or whatever else. It just slows you down. And then it's missing key terms. Does the investor have most favored nation rights or pro rata rights or right of first refusal? Those types of things. Okay. Then you look at the Carta decal cap table. Okay, this is a screenshot of what's there. Notice there's no vesting information. Okay, that's one of the most important things that an investor will want to see is how much of the stock that's been granted to the founders has vested. Because if too much has been vested, then the investor will feel like that founder is not tied to the company financially and incentivized to stay. So the investor wants to see that, but it's not here. It's not clear how much is in convertibles, how much the convertible instruments will impact the overall dilution. So that's something I end up having to do some manual mathematical calculations myself as an investor reviewing the cap table. I don't want to do that manual math every single time. It's also not clear from this report. Where's the fully diluted shares? That's the denominator in the ownership equation. Okay, so that's painful. Which one is this? It's 6 million, 1 million. Oh, okay, it's the one on the right, 7 million. And then there's no detail here about warrants. Granted, warrants are not common in early stage startups, but I do see them from time to time. Okay, especially some accelerators ask for warrants now as payment for their to be part of part of the program. Bottom line is this Carta export desperately needs some user interface engineering, a redesign. Okay, which is why we have our cap table tool. Okay, you'll notice just by glancing at it, it's more information, more tightly organized. We have all the common stock, preferred stock, and restricted stock awards in one spot with all the options, the stuff that could become stock later, incentive stock options versus NSOs, non-qualified stock options. It's important to have that separated because I've seen startups make a mistake where they give a non-employee an ISO. That's not right. You can only give NSOs to non-employees. Then there's the warrants are here as well as RSUs if you happen to be issuing RSUs. Then there's a calculation of your total fully diluted stake. It also has up-to-date vesting of the stock as well as the stuff that could become stock so that you can at a glance quickly see the level of vesting of everybody who's on the cap table who has vesting. You break down the option pool details across, again, the ISOs, NSOs, RSAs are part of the option pool. Okay, not a whole lot of people realize that. So if you've given a lot of RSAs, then I want to make sure I understand how much is left in the option pool, and I want to make sure that the calculation is correct. Okay, so then there's an aggregate stake. If somebody has gotten multiple grants, I want to be able to see what their aggregate ownership stake is. Calculation on outstanding shares, the fully diluted shares is one number there. And We also include fully diluted stake with an estimate on the impact of the dilution from the conversion of the convertibles. This is very important, but I very rarely see it. This is not an accurate pro forma. Do not mistake that because the conversion math is very complicated. It is an estimate only, but it at least gives me some directional idea of the level of dilution that will happen when the convertibles convert. This is important because a lot of startups nowadays are signing 20, 30, 40 convertibles. The last startup I invested in had 43 convertible instruments. I was number 43, I guess, or 44 or something like that. Okay. So this is our cap table tool. It's built in a simple spreadsheet, so you can load it into Google Sheets. It's built in Excel, meant to be used in Excel, but you can load it into Google Sheets if that's what you use. Okay, so that's the cap table tool. Financial models. Most financial models fail diligence. I'm an operator and I've played a CFO, fractional CFO many times. The financial models usually are kind of weak because they're not clear, they're not detailed, and they're not reasonable. So, not clear. What do I mean by that? The model has to be readable and intuitive. A lot of times I get this, rat's nest of a financial model. And even though I'm an Excel power user, I don't want to spend the time reverse engineering your math and validating whether the assumptions are reasonable. You might as well deliver the financial model in Greek. Okay, it's unreadable to me. All right. There's also the challenge of it not being detailed. Model should be monthly and bottoms up. Most financial models just estimate sales for the next 3 years or whatever. Okay. But you also need to estimate your customers because that justifies the sales, the expenses, which tends to be variable based on your revenue, your headcount, because the more sales you have, the more people you need to hire to support that or to close more or whatever. Then it also has profit and loss. It's the combination of the sales and those red things at the bottom, which affects your cash flow, your profit, which then justifies how much money you're going to need. I don't want to hear you say, I'm going to raise, X amount today, and then, I'm going to raise 500,000 today, which should get me this to this milestone, and then 2 million tomorrow, which will get me to the other milestone. I want to that's great to summarize. I want to see how the financial model backs up what you just said, because if you're wrong and you run out of cash early, you will now have to raise money in distress, and I'm going to get diluted extra badly, just as you will, if you raise money in distress. I don't want to get washed out. So your financial model needs to justify your ask. It also needs to be monthly, not annual projections. If you do annual only projections or quarterly alone projections, you can't track variance on a month by month basis. You won't know easily whether you're falling behind schedule or you're a little bit ahead. If you're falling behind, you can't make corrective adjustments in time. So as an operator, you absolutely need to be able to see this on a monthly basis. And most importantly, I want to see multiple scenarios. Almost all financial models I get have one scenario, whatever they say it's going to be. Well, what if you're off by 20%? I want to see the aggressive scenario. I want to see a conservative scenario. And the financial model should have that. Most of them don't. Okay. Most financial models are also not reasonable. They have to pass a sniff test. They need to have clear, realistic, and achievable goals. So our tool, our diligence package includes a financial model template for you, where we put all the assumptions in one place, one spreadsheet. Every orange background cell is an assumption. It's a knob that you can turn, okay? It breaks down customers and sales, which then rolls up, it breaks down the number of customers that you achieve, as well as the average revenue per customer, which then calculates into your sales on a per month basis. On a per month basis, we have expenses, one time, fixed and variable. You also then calculate your cash flow and profit. And of course, the biggest expense in most startups is headcount. So you need to break that out separately instead of just saying we're going to hire, $2 million worth of engineers. Well, I want to see how many engineers that's going to be, how much you're going to pay them, and when you're going to bring them on. And that's what the headcount analysis does with hiring dates. All this flows into an executive summary with the 4 different growth scenarios that the model supports. You also have some basic graphs that are auto-generated from the tool. Okay. And it goes monthly detail, goes 5 years out, Even though most investors only ask for 3 years, the model supports up to 5 in the unusual event that your investor asks for that amount of time. It is more common to get a 5-year model request when you're a hard tech company, a deep tech type of company. Okay. We tried to balance ease of use versus complexity with this. I view this as a simple financial model. I actually have a much more complex model, which is part of my financial modeling class. Okay, so now we're going to talk about QSBS, Qualified Small Business Stock. Okay. This can save both the founder and the investor several million in taxes, $2, $3 million, depending on the type of exit, if you have a nice outcome. This is so important that a number of service providers now charge anywhere from $2,500 to $25,000 to do a QSBS attestation. Okay, just do a Google search. How much does a QSBS attestation letter cost? 2,500 to 4,500 for certain size companies, and then there's a high volume provider that charges that. And then if they have to look back in history, and it's not just today, then they'll charge 12,000. So that's from a high volume provider. If you go to a specialty provider that's not high volume, they can charge $25,000 or more. Okay. Our toolkit includes a QSBS self-attestation form. It is not the same as a formal review, but it does summarize 7 simple requirements that the current QSBS rules ask for. It's all in the form. You just look at the 7 and say, yep, yep, yep. I satisfy this, 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 this. You initial and you sign, and there's additional links for more information if you needed to get some more background. This is included as part of the toolkit. The fundraising journey. So again, another tool in the toolkit. The past, present, and future fundraise with financial terms of each one of the raises allows you to calculate the valuation growth, and that growth from tranche to tranche shows investor momentum. It also captures key legal terms in some of the past and some of your proposed future raises, which then all this adds up to your current raise and your current plan. This I've just highlighted like 3 or 4 of the tools, okay, that are in the toolkit. It's all built within the trenches experience. When I've been doing this for such a long time, I see all the pain points, and I built basically the functionality that I want to see as an investor, and I want to just do color by numbers, fill in the forms as a founder instead of spending 200 man hours to fill in the diligence request. Hopefully, if you use this process, it can simplify a lot of stuff. We do have a brand new diligence class, which includes the 22 tools in the toolkit. We sell the class for $299. For people who are on this webinar, you'll have access to buy it at 40% off, 179 bucks. This will expire tonight. Okay. So if you're interested, you can scan the QR code, or I will paste into the chat window the clickable link where you can just go to the checkout process. Okay. This class is probably, in my view, only 2/3 done. I'm continuing to build it up, but even at 2/3 done, we're at just under about 2 hours with about 100 slides. You've seen probably 10% of the slides. Okay. The class is ready to be used now. Okay. I have been using it for some of the diligence work. It's just that if you're doing a larger, like a $2 to $5 million fundraise, it's at that point we'll probably release that maybe in the next couple of months. But if you're doing angel rounds that are sub 500K, then the class is very ready to be used now. The toolkit is ready. In some cases, if you have a $2 million round and the investor has a light diligence process, you might even be able to satisfy the request with the toolkit as is. No, you don't need a discount code. The pricing is built in, no coupon, no whatever. But what we're going to do is tonight we'll go up to the website and the price will go up. Okay, so after tonight, this 40% offer goes away. Okay. There's a question. Is there going to be a recording? Yeah, we'll record this and probably post it up on YouTube. Okay. It may take us a week or two, but we'll get it up. Okay. Let's see. All right. Um, Happy to take any other calls. Or questions. We've got about 5 minutes here. Thank you for slogging through this. This is not the funnest topic, I understand, but it's actually a very important process because the back office, this stuff can, 80% of fundraisers fail largely because in diligence problems. And so there's another question. Will this course be in the premium training? We have a pro and a premium training pack, which is kind of the premium is every course that we have for $1,000. The pro is half of the courses we have for about 600 bucks or so. This class is included in premium. So if you bought premium in the past, you will get this class for free. Okay. Anybody who has the premium package, it's all current and all future courses. The next course that we're working on after this one is our pitch deck de-risking. We're up to 300 slides and 3 hours on that course right now. It's effectively our pitch deck template with tons of detail about exactly what we do when we're hired to rebuild a pitch deck for a client. Okay. Alrighty. Okay, so pre-revenue financial diligence. All right. So on the diligence, even if you're pre-revenue, you're still going to have a cap table. All right, that exists for every single company. You're still going to have the option grants. You may have existing investors. All right. You're still going to have a financial model. The revenue, hopefully, at some point in time, starts going positive, but you still need to be able to predict and estimate what your expenses are going to be and how much you're going to pay your employees, et cetera, et cetera. Okay. You're still going to have a QSBS attestation. You're still going to have financial statements, and you're still going to have details about your financial infrastructure. So 100% of the tools in the financial column are still relevant, even if you have no revenue. Okay. Do-do-do-do-do. Okay, I'm trying to catch up with a couple of questions. I think Chicky Fitzgerald mentioned that you might have double purchased. If that's the case, we'll make sure to refund you. We're not here to make life difficult for anybody. Okay. What kind of due diligence is required in partnering with a company that is not investing in your company? Ah, okay. Very good question, Don. Diligence required for partnering with a company is not investing. So, it's usually not this level of diligence. It's really mostly the commercial diligence and in some cases some of the technical. They will rarely ask you for any type of diligence checklist. It's more of an informal process where every partnering agreement is going to be different and you need to evaluate the business side of who gets what and whether it's reasonable. In some cases, if you partner, maybe one of the most common use cases is going to be a small startup that partners with an offshore software development firm. I see that happen all the time. And you're not going to go through this type of diligence at all. It's usually not the case, but I would recommend that you diligence the number one, the offshore company's development capabilities, but more importantly, their processes. Most cases where a software development project, outsourced software development project goes bad, goes sideways, is not because they didn't have a guy who could write code. Sometimes that's the case, but probably 80% or more in my experience is lack of clarity on requirements, lack of status updates, poor sprint management, all these other things that wrap around, which are more process centric. Those are things that you might want to diligence with the potential partner. And then the same thing might apply if you're doing a supplier QA checks or a manufacturer, things like that. So because that's very, very different type of diligence, it's not going to uh, it's usually not going to, this type of toolkit that I'm explaining here is usually not applicable for those types of relationships. Okay. Chicky, how do we show sweat equity? Use slicing pie. Okay. Great question. So slicing pie is a dynamic equity allocation system. It's very interesting. Mike Moyer has it on his slicingpie.com website. I've actually used it before myself. So you still are going to have a cap table, and if you are full slicing pie and no one has any equity except for what slicing pie says, you would use the slicing pie tools to be able to report that. If you have taken any investments, that is going to be on the cap table for sure. Okay. Assuming that it's dilutive type of investments. Okay. And if you are doing some type of hybrid where it's half fixed and half slicing pie or whatever, then you're going to have a line item on your cap table, which says something to the effect of reserved for future slices of pie or whatever, something like that. Okay. Alrighty. Regarding the financial model and cap table, just clarify, I believe you mentioned these are Excel sheets. Yes, the financial model and cap table are both Excel sheets. The due diligence worksheet is also an Excel spread right now, and I'd like to actually build in a lot more functionality with this diligence tracker. Right now, it is a spreadsheet. Okay. The financial model, the how are scenarios calculated? Very good question. Okay, so what happens on the financial model is if you obviously you can't see the low level detail, but on the left you'll see all the orange, the screenshot of all the orange, and that's all the knobs that you turn. Notice on the far left of that screenshot, there's a pink, orange, yellow, and green. The Each one of those colors is a different scenario. So when you're estimating customer growth on a per quarter basis, you estimate it for all four scenarios at the same time. If you want to do four scenarios, if you say, no, it's too much work to do four scenarios, I'm just going to do one for now, then fine, fill in one scenario, leave the other three blank. But when the time comes, if you have an investor who says, oh, that seems a little optimistic. And given the state of the economy, what if you don't hit those numbers? I want to see what happens if this goes down by 20% or whatever. Then you can, at that point, build your second scenario. Okay. So it's automatically built in, and it's nice because it's all in one place. You can kind of compare side by side. Like, this reduction in 20%, what does that really do to the expenses to the compared to the other scenario, whatever. It's nice because you can kind of engineer it and see if it's reasonable before you give it to an investor. All right. Okay. Yeah. It's an NDA included in the toolkit. No, I don't have an NDA because those are generally very simple documents, and you don't create an NDA for diligence. You already typically already have that. There's tons of places to be able to get NDA templates. Sophisticated, you read my twice on the Game Change podcast. Oh, okay, great. Do, 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 do. Can you provide the link to the key sections of the executive summary that business angels like to see that you suggest on the executive? Oh, okay. Um, so on the executive summary document, there actually, if you go to the Band of Angels executive summary template. Oh, I've got to give you the link for that. Let me see if I can find that real quick. But if you go to the Band of Angels executive summary, um, there's not one key portion of that document that an investor looks at more than another section. I look at everything. And most of the investors do as well because what you're trying to do is get a sense for the overall picture of the company. And startups are complex. It's not just, I don't just look at a startup because the financial model is, promising. Well, it may be promising, but what if there's some regulatory thing, like let's say you're Uber, and in order for the financial model to work, you have to get a license to operate your gig economy driver. You have to get a license to operate in London. Okay. That's not going to be reflected on the financial model. So that's why multiple things kind of come into play. There's a section where talks about key milestones in the in the one page executive summary. Lots of things. There's not one specific section that stands out over another. Okay. Somebody said you should record a video explaining the due diligence folder. Sure, that doesn't hurt. Hopefully, if the investor is gets familiar with this toolkit, and I've had talks with. I'm a member of the Angel Capital Association as well. I would love to see angel groups across the US just standardize. Because what's the point in everybody having a different financial model? Okay. And then angels have to decipher a custom financial model every single time. Just use a standardized template. And again, the financial model that's in there is what I consider a simple model. It doesn't look simple, but to me it is. Okay. Financial models can get super complex. We're not gonna be able to cover that with this. For what it's worth, I have here. I'm gonna just animate straight this. These I have three financial models. The one in the middle is the one that's included. The standard spreadsheet's included with this class. I have an advanced spreadsheet which is included in the financial modeling class, and then I have an expert version which I use myself. I don't distribute that when I'm asked to build a model for a customer. Okay, so there's lots of different models. I consider the one that's in this diligence class to be standard or simple. Okay. Alrighty. Oh, Brian, thank you for providing the link for where you can download the Band of Angels one-page executive summary. Okay, thank you very much. There's a question. I mentioned that the state of the class today and the toolkit today is focused on a sub 500K raise. If you're looking for to do a $2 million or higher raise, what should you do? Well, I am always a fan of prepare your diligence content now. Don't wait till the last minute or till an investor gives you a term sheet and then you're scrambling. Okay. It's the same type of thing. In the class, the full version of the class, I have an analogy about hygiene, and everybody feels like you're too busy to deal with diligence. But the reality is, even though you're busy with your startup and you have tons of things to do and you not enough hours a day, you still shower and you still brush your teeth because hygiene is important. Okay, you don't want to offend people, you don't want your teeth to fall out. Same type of thing with diligence. Yes, it's a grind. And if I didn't have to brush my teeth or shower every day, I'd probably save an hour. But my wife would hate me and everybody would steer clear of me. Okay. Um, so I encourage, even though this diligence kit isn't expanded to cover the level of diligence for a multi-million-dollar raise, that's right around the corner. In fact, I started with that as the first release, and then I thought, it's too much work. Let me pare it back, and I had to go more minimal on my minimum viable product for this diligence package. Okay. I already have a lot of the content for the $1 million version, which is really just most of it is additional detail on the data. So this is what's included in the current small fundraise. This is a hidden slide, what's included in the next version. So I've already been working on some of that. So it's coming. Okay, it's coming. If you if you have the time to invest, in fact, I should say, please make the time, whether you use this toolkit or not, please make the time to get your diligence in order. Because once you get a term sheet or once you get an interested investor, it's too late. You're going to be scrambling. Okay. All right. Okay. Is there a way to connect it to QuickBooks for actual expenses to flow into the financial model? Okay. No, there's not a way to do that right now. I don't recommend taking my financial model and connecting to QuickBooks. Okay. What I actually recommend is you use a third-party software product to do it. Okay. Because the model is, it's too much work, in my opinion, I've served as a hands-on CFO. I think it's too much work to export and then manually import this, that, whatever. Okay. And in this version of the model, this version does not have line item expense detail. Be clear on that. Because the advanced version of the model has that. But in my opinion, because every startup is different, the line item expense detail would also be different. So one company might have a certain type of expenses that another company will not have, and they will not need to track. And therefore, doing that level of granularity no longer makes this financial model in this class simple. Okay, so I want to make sure that's clear, is that it does not have line item detail. It has bucketized expenses on a per month basis. So I would not recommend, in fact, because it doesn't have line item detail, you can't easily connect it to QuickBooks. What I do recommend is you use a tool. I tend to refer a lot of people over to Forecaster. They are just like Carta is to cap tables, Forecaster is to financial models. Okay. They have a lot of great functionality. In fact, after Forecaster released their platform and I started using it, I don't use my expert spreadsheet almost at all anymore. Okay. I almost always say if you want to do this, do it in Forecaster because Forecaster does sync to QuickBooks. It only does one scenario, so it doesn't natively support multiple scenarios. If you need multiple scenarios, you have to build your scenario, do a save as a different scenario type. Okay. That kind of is a hack to support multiple scenarios, but then if you make a foundational change, now you have to percolate that change down, trickle it down to both scenarios or all three scenarios that you have, which is why I say it does not natively support a single scenario. Okay. Send me an email, and I can introduce you to some of the folks over at Forecaster if you want a demo. I can also offer a discount. Since I refer to them, I refer so many different startup founders to Forecaster. They offer discounts. Okay. Uh, okay. That's explaining about the financial line. I'm details right here in your standard specialist conversations writing this. Yeah, yeah, you're absolutely right. Some one of the comments is about the financial model. It's real. This is not an operational model. The financial model that's in this class. It is meant to paint a picture of the future, and hopefully you'll use another tool like a forecaster, or there's other tools as well. There's yeah, if you're interested. These are several other platforms, Forecaster, Pi, Runway, that also do hosted financial modeling. You're gonna pay, okay? But they do it as well, okay? So if you're going to do an operational model, then I'd recommend using one of these tools, okay? I tend to use Forecaster the most because I've been using it the longest. Okay. So we are over our time. If there's any other quick questions, I'll try to tackle it. But thank you for spending the extra time here. I don't see any questions that I didn't hit yet. Okay. All right. I apologize if I missed your question. If you ask real quick, I'll try to get to it. By the way, if you do have the ability, if you enjoyed some of the stuff that we do, we're trying to build a database of testimonials. Okay. If you just be kind, we'd be greatly appreciative if you would just send us a testimonial about what you've gotten out of what we try to do and how we try to help founders. Okay. Thank you very much. And good luck to you. If this was helpful, please like this video and subscribe to our channel. You can also check out our other videos for more startup content.